is of the view that good companies do not always qualify as good investment, and that is the reason why in the last couple of years, while companies like SBI, companies like NTPC, they are not really the best go-to stocks. They have not been the best go-to stocks and best go-to companies, but they have turned out to be good, great value stocks, and that's why Prashant has differentiated his portfolio. Clutter the filter, focus on what is cheap, because investing is all about buying something which is available at its below its intrinsic value. Prashant, fantastic to have you on ET Now. Thank you for joining us. You've been associated with ET Now right from its inception. So on our 13th anniversary, it gives me great pleasure not only to welcome you back, but also on behalf of everyone from ET Now to say a big thank you. So Prashant, my first question to you is that it is looking scary. For a market where a couple of months ago nothing could go wrong, looks like now nothing could go right.
I think, Nikunj, see, these are things, I mean, that's why sentiment is so hard to forecast, and things change quite a bit. And who would have thought that what is happening in Ukraine will happen? And that has led to a sharp spike in commodity prices. It has increased inflationary pressures, and clearly the rest has followed. And that's why we always say that equities are extremely hard to forecast, very risky over short to medium periods. So I think where are we? I think inflation is here. US bond yields have gone up by almost 2.5%. Indian yields have also moved up. Markets have come off, and excesses in the markets have corrected. If you look at the Indian context, markets have been now broadly flattish for between 1 to 1.5 years. And this is a reasonable period for an economy which has grown in high single digits last year, add to that inflation. So that means in terms of nominal GDP, the markets have underperformed significantly. So I think as I see the outlook for Indian economy, for corporate profits in India, is steady, and I think there is some value that is beginning to emerge now in the markets, and because a flat markets for 1 year leads to 15% lower market cap to GDP. So I think I am a little more constructive than what one has been in the recent past years.
All right, so you're sounding positive, and that's a different Prashant Jain, I must say so. What makes you positive? What makes you positive about investing into equities when the interest rate cycle is against us? You know, interest rates, they matter, Prashant. We both know that. Like Buffett says, interest rates are like gravity. If they go higher, equity valuations will come down.
And I think, Nikunj, that's a very fair question, and I think there are two things I would like to say here. See, even in the past, if you look at the history of Indian capital markets, we have seen interest rates at higher levels. Even US 10-year yields were quite high until some time back, especially pre-Lehman. And even in those times, our markets used to broadly track the nominal GDP or the profit growth of the country. So I think interest rates are an important factor. But I think over time, and this we have discussed in the past also, over time, growth dominates, or returns are more determined by underlying growth and less by interest rates. Coming to corporate profitability, I think the impact of rising interest rates might actually turn out to be positive in India, at least for the time being, counterintuitively. And that's because almost a third of the profits of Nifty in India come from banks. And banks, the way they are positioned today, bulk of the loan book or a large portion of the loan book is floating. And therefore, a rising interest rate environment should help NIMs. And we are also seeing credit growth picking up. While many of us believe or feel that rising interest rates should lead to slower loan growth and vice versa, I don't think things work out that way in real life. I mean, if that was the case, then last few years interest rates were so low but loan growth was also quite low. So I think credit growth is more a function of how the economy is doing, how are demand conditions, how is capacity utilization, how are the balance sheets and cash flows of companies. And I think today I feel that with every passing year our credit growth should improve, and rising interest rates of course are good for banks. Bulk of the other corporates are substantially deleveraged. The corporate leverage in India is at a 10 to 15 year low. So I think the impact of rising rates on profitability in India should be quite muted for quite some time. In fact, many cash rich balance sheets will earn higher other income if interest rates go higher. Coming to the second impact of interest rates, and that's on multiples. Yes, cost of capital goes up, so it should bring down the fair multiples. So I think, but today what has happened because of this long time correction in Indian markets, valuations are looking quite reasonable. The outlook for profit growth is quite decent. Corporate balance sheets, bank balance sheets are extremely healthy. So I think even if you work with reasonable multiples, I think we are at a level where next few years or over the medium to long term, I think returns should broadly track nominal GDP growth rates.
Prashant, now let's look at the compulsion in the market. Crypto as an asset class is not in a bear market, but it is in a meltdown phase. There's a bear market which has started in S&P. Huge deleveraging has started in some of the US tech stocks. So my question is that when there is so much of unwinding and deleveraging happening in the market, and historically when we have seen this kind of an wealth destruction and deleveraging, it will always impact markets because of compulsions. Is that a valid fear? If I say that right now more than valuations, it's the compulsions which could damage the prices.
I think, Nikunj, we have already seen quite a bit impact of that. If you look at FII selling last year and this year, it is now touching almost 30 billion US in just year till date. And I think that was probably, some of it was anticipatory selling in expectation of US yields moving up. So I think to that extent there has been some impact. I think the broader markets or the pockets of excesses have had far deeper corrections in India and outside India. And we have seen time and again that when the operating environment or the environment for capital markets becomes slightly more difficult, the excesses tend to go away quite fast. And I think we are experiencing that phase. But fortunately for us, the Nifty has held up extremely well, driven by substantial local flows. And as I said, the valuations out there are looking a lot more reasonable. Banking has corrected, technology has corrected. These are very strong sectors with large index weights. So I am not saying that markets will go up from here or they can't correct more, but I do feel that over time, as strong growing businesses are now available at reasonable valuations, I think the risk reward is looking better today than what it was looking few quarters back.
But Prashant, if inflation goes higher, the whole construct of value investing changes, because inflation and interest rates play a very large role in how you underprice the asset classes. Won't your view on value investing change because of high interest rates?
So Nikunj, you are right. I do avoid excessively valued sectors, and I think that has held us in very good stead over time. But coming to inflation, see, equities are a hedge against inflation. It is the bond investor who should really worry about rising inflation and therefore rising cost of capital. And if you look at the composition of Nifty's profits, as I said earlier, 1/3 of profits are coming from banks. Inflation goes up, interest rates goes up, it is actually not negative for banks. Roughly a quarter to a third of the profits of Nifty are coming from commodities or commodity types, like refining margins, etc. There again, the elevated commodity prices, the elevated refining margins are positive for that 1/4 to 1/3 of the market. About 15% of the market or profits is in pharmaceuticals or utilities, etc., which again is broadly not impacted by inflation. So the only place where inflationary pressures could hurt margins or demand is the consumer space in India, both the staples and the discretionary, and that is about between 10 to 20% of the profit pool of Nifty. And over time, even there we have seen that these companies will pass on cost hikes to the consumer, maybe with a lag. So I think the very nature of the equities is, one, they offer you a hedge against inflation because these are priced on to the consumer, higher prices, and specifically the composition of Nifty profits is such that it sounds very counterintuitive, but inflation will actually probably lead to some earnings upgrades and not downgrades.
And with that, Prashant Jain, thank you so much for joining us live today. It is the ETNA 13th anniversary. Thank you for being with us those last 13 years as well and being a regular guest.